the 17th of October 2025, right? So what's in store for us today? Today, I'm going to share about the monetary policy recalibration in the United States, United Kingdom, as well as Australia. Now, within 2 days, 3 governors reset the temperature of global policy, right? Jerome Powell signaled the Fed is near ending balance sheet runoff and is watching a softer labor market. Andrew Bailey described a UK economy easing off the boil even as inflation lingers, and Michelle Bullock said Australia's stance is only marginally tight with the output gap near balance. Now, what does all this mean? Is the era of blanket tightening is giving way to careful calibration. So let's go into detail, each and every central bank, what are they talking about? Let's start off with the Fed. So what was said? Now, Powell suggested reserves are nearing an ample level and that ending balance sheet reduction is in sight. He emphasized a softer labor market bringing the risk to inflation versus employment closer to balance, keeping further rate cuts on the table. Now, he also noted that recent goods price bump may be more of a one-off from tariff and a less a sign of an overheated economy. Right? Now, what does that lead to for the policy path till December, end of this year? Now, most likely the Fed stops shrinking its balance sheet and then eases in small steps as the labor market cools and inflation edges towards target. Now, if services prices stay sticky or growth re-accelerates, cut could be delayed or in smaller sizes. If the jobs data weaken faster, the pace of easing weakens. As for the economic effects, ending quantitative tightening reduces pressure on long-term yields and should ease overall financial conditions even before additional cuts. Now, employment growth slows, but the base case does not assume a recession. Consumption cools and capital spending stabilizes once uncertainty fades. For the US dollars, if the Fed cuts earlier or faster than peers, US dollar tend to drift lower versus cyclical G10 like the Aussie, New Zealand, Canadian, Norwegian kroner. If global growth sours, investors seek safety and the dollar can firm even as Fed eases. The base case is choppy trading around data releases and tariff headlines. For the Bank of England, what was said, Bailey sees some softening in the labor market and must balance against above target inflation. He's not seeing much tariff pass-through yet to prices. UK businesses report delayed investment because of uncertainty. Now, as for the policy path to December 2025, the bank moves from a single-minded inflation fight to a more balanced stance and cut slowly. It's likely lags, the Fed unless the disinflation speeds up at home in UK. If wage growth and services price remains firm, the bank stays higher for longer. If demand and investments weaken more clearly, the easing cycle becomes more and more obvious. Okay. Now, as for the economy effects, the economy growth remained weak for the UK. Softer hiring and postponed investments hold back trend growth. Inflation moves lower, though it's bumpier than in the US so far. Right? So for the pound, if the Bank of England is later to cut, then Fed rate differentials can support pound on rallies. But weak growth limits the top side. Base case range trading for pound into end 2025. For the Reserve Bank of Australia, what was said, Bullock described policy as only marginally tight with the neutral rate around 3%, but with high uncertainty. Consumption has been a little stronger than feared. Unemployment near 4.2% is acceptable. Headline inflation is jumpy. The output gap looks close to balance, and slow productivity restrains wage-driven heat. So what does that lead to the policy path to December 2025? The most likely outcome is a long hold with a slight easing bias. If inflation settles inside the target band and growth cools, 1 or 2 small cuts in 2025 are possible. If consumption stays firm and inflation remains jumpy, the hold simply lasts longer. Okay? Now, fresh pressure from housing or services would also argue for patience. Clear disinflation together with softer labor conditions would bring earlier and shallow cuts. Okay? So, with regards to the economic effects on the Australian economy, since the economy is operating close to its potential based on Bullock's update, there is no urgent case to raise or slash rates. Okay, it's just possible, but there's no urgency for that to happen. Slower productivity argues against rapid wage-led overheating, but also caps trend growth. Okay, so let's see, whether it can grow. It's just more like if it goes also, it's not going to be like parabolic right now. It's just like slow climb if there is. Now for the Australian dollar, with policy near neutral and strong links to China and commodities, the Aussie tend to do well in a soft landing world where the Fed is easing. If global growth wobbles or the RBA, Reserve Bank of Australia, turns dovish ahead of others, the currency underperforms. The base case is gradual firming into late 2025 if commodities and risk appetite hold up. Okay, that means overall the world economy is good, then this is the possibility. The Aussie dollar firms and starts to move up. So anyway, for all three, data to watch. For the US, payrolls, unemployment, core services, prices, bank reserve conditions as balance sheet runoffs ends. Okay, so especially this one, bank reserve conditions. The repo rate is at its lowest right now. And if the conditions that the Fed doesn't increase this, right, liquidity is going to dry up, and that's not good for the US economy. Okay, so that can also mean that the taps, the Fed may turn on the taps very soon and flush the market with cash. Okay, but they need to balance it properly as to ensure that inflation doesn't creep up once again. For the UK, wage growth services, inflation, business surveys on investments and job vacancy measures. For Australia, quarterly inflation, wages, retail volumes, unemployment, and trend in iron ore and liquid natural gas exports. Okay, so that's the update from all the three major economies so far.